If you're constantly getting stopped out watching price move exactly where you predicted, there's a good chance your analysis isn't the problem, your entry is. You probably know what a fair value gap is, you probably know what a breaker block is, but knowing what these concepts are doesn't mean that you know how to actually use them together. Today, I'm going to show you the exact entry model that I use to go from identifying an opportunity to actually executing the trade. And at the end of this, I'm going to take you through a real setup step by step so you can see exactly what I'm looking for before I ever click buy or sell. Now, a lot of traders learn these concepts individually. They learn liquidity, fair value gaps, order blocks, breaker blocks, but they never actually build an entry model, right? They see a fair value gap, they press enter. Sometimes they see a breaker block, they press enter. They see any type of displacement and they can't wait to get into a trade. And then they're confused as to why they're getting stopped out. A concept isn't an entry model. An entry model tells you what has to happen before you're allowed to take a trade. Okay, so put it like this: context, then liquidity, then displacement, then fair value gap and breaker, then a retracement, then an actual entry. Now, before I even think about entering, I need to know what the market is doing. What is my directional bias? Where is the larger area that price wants to go? Okay, am I looking for buy or sells based on the bias? Next, I want to know where liquidity actually is. What is the obvious highs and lows, right? Where are traders placing their stops? I'm not just trying to figure out where I want to enter. I'm trying to understand where price is trying to go. Okay. Then once liquidity is taken, I want to see some form of displacement. I want the market to actually show me intention, right? I'm not interested in tiny candles that barely move. I want to see an aggressive move. And 9 times out of 10, that move is going to leave the fair value gap, which is step 4. The fair value gap gives me the area where I could potentially get involved. That way I'm taking a trade from the same PDRA, the same concept every single time. But the key word is potentially. I'm not automatically just entering just because I see a fair value gap. Okay. Now I want to see that stacked with a different confluence, because what I usually say is any confluence by itself has a 50% win rate, right? But when you stack it with another confluence, it increases by an undetermined amount, and anything above 50 is profitable. Okay. So now we have a breaker block on top of that, which adds another layer. The last thing we're going to be looking for is a retracement. Okay. And this is where most traders get impatient. They can't wait to get into the trade. They see any form of displacement, they see any form of volume, and they want to get in. Now they're chasing price. They're not waiting for the best possible opportunity, but I'm going to wait for the retracement so that price can come back to me and I can get the best entry possible. So here we go. When it comes to executing your position, there's 2 things we need, right? There's 2 things I look for. First is the phase 1, which is context. We need context on the chart. We need to know where price wants to go. We need to know if we want to look for buys or sells positions, but that's not what this video is about. Today's video is about actually properly entering the market and being able to get into the market where it makes sense. That way price can actually run to TP. Okay, so what we're going to be learning today is our breakers and fair value gap entry, how to spot a breaker, how to know which fair value gaps are going to work, and what to target overall, right? So as we can see, we have an example right here. So understanding context is very important. Without that, this and anything you learn, any strategy you learn, which is just an entry and exit system, is not going to work, right? Because if you don't know where price wants to go, then there's no reason for price to actually follow whatever you're trying to draw out, right? There's no reason for price to respect the PDRAs you're drawing. There's no reason for price to respect the lines you're drawing, anything like that, right? But once you have your context and you understand, okay, in a situation like this, we're looking for some type of sell narrative. And like I said, this is not the phase 1 video where I go over context. If you want that, just go ahead and check out my Futures Insiders course that I have up. There's a lot more information there. Okay. But here we go. What is a breaker block? So a breaker block is essentially formed when price takes out a high in the market, right? Then breaks below a low that was put into the market before the high was taken out. Okay. Let's make this a little bigger for you to see. Okay, so as you can see, we have an up and a down candle, which puts a high in the market. Price takes out that high, right? Now, after taking out this high, there's a existing low in the market. We also have another one right here, right? And watch this. This is very important. So we have these 2 lows that exist prior to price taking out this high, and then we get a candle close, keyword close, below both these lows, right? Now, at the point in which this candle closes, these breaker blocks that we're looking for exist. And these breaker blocks will be the down close candle, right? The last down close candle in the sequence. So in this case, we have 2 lows, right? We close through both these lows. These are lows that exist prior to price taking out the high. These are both breaker blocks. Okay, so now we have two breaker blocks on our screen. The only question we have to ask ourselves is which one do we actually trade from and stuff like that, which is where the next part of our confluence comes in, which is our fair value gap. Okay, so what we want to see on top of just these breakers, we want to see price stack with a fair value gap, right? 3 candle sequence, bottom of the first candle, top of the third candle in a sell situation, right? So this is obviously a sell example that I'm showing. And as we can see, now we have our fair value gap stacking within both our breaker blocks, okay? Now, there's multiple ways to play an entry off of this, right? You could say, do I want to take the trade off the first breaker block? Do I want to take the trade off the second breaker block? If there's only one breaker block, obviously it makes it very easy, right? But these are just things you have to backtest and see the win rate of. What I think is best is for you to take the breaker block just based off of your risk itself, right? So you slap in a position and you're not necessarily looking for which breaker to take it from. You want to pay attention to your targets, right? So here we go. We have a low hanging fruit. That's what I like to call it. The initial low that's put in before the retracement, right? And then we have to pay attention to our stop losses. Are we stopping our trades at the end of once price disrespects this high, right? Are we going a little tighter with the top of this fair value gap, which is what I usually like to do, right? But let's just say for what's more common, we have stops somewhere like right here. Now all you have to do is play your entry in a position that you're comfortable with the risk to reward, okay? So, and you got to keep it consistent though, because the thing with trading is things need to stay consistent. You're not jumping around. You're not one time taking trades down here, taking ones up there, stuff like that. You got to play it consistently. So for the sake of this, let's say we go for trades that give us a 1-2-1 at the very least, right? So just like that, we get tagged into our position right here. There'll be some times where you don't get tagged in. There'll be times where you do get tagged in. But now we're tagged into the position. As you can see, we get instant rejections, right? Because we're on the 1-minute chart. We get instant rejections and price just sells off to our low-hanging fruit. Now, low-hanging fruit is just the initial TP suggestion. Okay, it's not where we're going to place the TP. Finally, it's just the initial suggestion, right? So you can do something mechanical where you go for a 1-3, which is what I tend to be doing recently. Okay, go for 1-3s, 1-2s, right? Positive risk to reward ratio with a high win rate is how you succeed in trading. But most importantly, okay, most importantly is you need to manage your risk appropriately, right? Knowing when to go break even, knowing when to reduce your risk, knowing when to take some off the position, stuff like that, right? This is going to come with experience, backtesting, and just a full-on system in itself. Okay, so if you want to break down a lot of more of this type of stuff, just go ahead and drop a comment breakdown. That way I know what y'all want to see, and I can make more videos on that to help you out. And here we have ourselves a bullish example. Okay, so same things apply. What I like to say a lot is that the concept of what I'm speaking about holds more weight than how it looks on the chart, right? And what this means is that over time, you got to pay attention to what is being said. Okay, so for example, in the last example I told you, a sweep of liquidity, a break of structure, right, within a high that was put in before the sweep took place, right? And then what else? A retracement. So let's see if this still applies to the example I'm about to show. Okay, so here we look. We have a down and an up counter. That's a low. We have sweeps right here. So we're taking out the liquidity, right? After we took out this liquidity, look at a high that existed prior, right? We have this high right here. We have some other highs right here, right? Okay, so we have highs that existed prior to the sweep. Then what do we want to see? We want to see our breaker block be the up close candle because this is a bullish situation compared to the last example, right? So we have a possible breaker right there. Actually, not possible. This is a breaker. We have a breaker right here. And then we also have a breaker right here. So another situation where we end up having two breakers within this push. Next, we want to see our fair value gaps. Okay. So as you can see, we have a gap right here to stack. We also have another gap down here to stack. Now, another situation where we have to figure out what is our risk, right? And use that to determine where we're actually going to take a position in here. Because look, if we took the position all the way up here, right, where would our stops need to be? In a situation like this, we want stops to be below the breaker, right? Because we're expecting price to use these breakers as a reason to move forward. So we wouldn't want our stops anywhere inside here or here, right? We want our stops at the bottom of these breakers. So somewhere right there. Now we are initially targeting the low hanging fruit, So look at this risk to reward. It's a poor risk to reward, right? This wouldn't be a trade you want to take, even though it plays out. You wouldn't necessarily want this, right? Because when it doesn't play out, you would end up losing double. So you need 2 wins just to make up for 1 loss, just because you didn't get in at the right position, right? So like I said, back in the last example, keeping things consistent, we would want to take this at a 1-to-1. Okay. Notice how we choose where we enter. You have to control the things you can in trading, right? We don't control how these print. We don't control when they print, what time they print. We don't control how the actual setup looks, right? Notice how the last one looked more immediate, right? It was immediately taking this, breaking structure. It looked more immediate, but this one is spread over a longer period of time, but the same things apply. The same concepts that we're preaching, the sweep of this low, the highs that exist before the low gets taken out, right? The fair value gaps, the stack, it's all the exact same thing. It's just not going to look the exact same way. Okay, if it was looking the exact same way, if it was that damn simple, I mean, that damn easy, everyone would do it, right? It's still simple. We're still looking for the exact same concepts, but it's just not easy because you have to actually master the concepts and understand the ideas behind it. That way you can know, okay, this is a breaker. These are gap stacking. This is where I should get in. Okay. So like I said, same way, right? Keeping things, consistent. We're looking for that 1-to-1. We have the low hanging fruit. As you can see, we're already looking better. Price ends up tagging us in still, which means we're still participating in this opportunity. And like I said, the low hanging fruit is just a suggestion. You can go for a manual 1-to-2, 1-to-3, right? So as you can see, this one runs up as high as a 2.9, right? And again, this is simply just based off of your entry. So if your entry was at a 1-to-1.5, right? If this is where you chose to get in based on statistics, guys, you don't want to be free guessing anything. These things need to be back tested. You need to be like, okay, whenever I get in at a 1-to-1.5 from my low hanging fruit, there's a 85%, 90% chance that we can run a 1-to-3. These are the type of thought processes you need to have when it comes to actually taking trade positions. But either way, as you can see, you're able to run this very, very long, right? And even though we don't get exactly that 1-to-3 coming in at a 1-to-1, like I said, managing your trade position is something that's essential. So at a 1-to-2, you could have trailed all the way up here. You could have trailed all the way up here. You could have trailed to this low while we're edging our TP. You could have manually exited. These are all different things that are going to come with experience and knowing what to actually do while you're in a trade. But long story short, the breaker fair value gap stack still plays out. Okay, so the positions are still running and we are able to enter and exit the market by knowing what a breaker and a fair value gap is and knowing how to put them together to give us this entry model.